Well, that escalated quickly. It is March 10th, one day after we made the video talking about a bank run, and in fact, that actually happened. And the crazy part about all of it is how fast this has occurred. So to give you a little bit of context, everybody keeps saying it's like Lehman Brothers and all that. Lehman Brothers didn't even happen in 24 hours. If anything, this is probably more comparable to Washington Mutual in September of 2008, which was a 10-day depositor withdrawal that eventually led to the collapse, and then JP Morgan buying them for pennies on the dollar. So it was wild today. I have a very special video for you. You're going to see what we're going to get into, but what I want you to understand with what happened today, just to give you more context, by the time we made that last video and the market closed yesterday, you had members of the Federal Reserve as well as the FDIC on a plane, and they arrived at SVB headquarters in the morning, and they already shut the bank down. The FDIC, they put all the assets in receivership, meaning any bank deposits, anything from here on out is going into a special bank account that is controlled by the FDIC. So this is absolutely wild, but not only did the Fed go there or the FDIC, I mean, here, just look. I decided to show up too. So let's see what's going on, and we have a lot to talk about. Give me a second, we'll take a look around. But yeah, I decided to show up too, and it looks like you got a bunch of reporters here. This is their headquarters. I guess we are not the only one who had this idea. And why? Because everybody was saying that everybody's showing up here to the bank and everybody wants to, someone's going to buy them out. And even then, if I were you, I would go look up the private airfield by here in Silicon Valley and take a look at any jets owned by banks. Because if they land here, well, then you know who's going to be buying them out. But the crazy part is we found out after hours, like Roku owns like 25% of Roku's cash is stuck in the bank and all that. And even Amex, and only 3% of the funds are actually covered by the FOMC. I'm sorry, this guy's just looking at me right now. He's staring hella in the camera. But it was covered by the, what's it called? The FDIC. So very interesting. But here, let me see if I can take a look around. Let's see what we got going on here. This guy's reported. Dang, it looks nice inside, man. Silicon Valley Bank. Here, y'all see that? Let's see, they doing stuff. But it's all newscasters. I'm probably on camera now. So we gotta get in and get out quickly. A couple of EV cars. And that's it. There's another entrance around the side. And then that's all, but it looks relatively like nothing, man. It looks calm. Very, very wild. And everyone's just waiting here for some action. All right, so I just got here. Very, very long story about everything that happened. So you guys get a little bit of a vlog style. I'm gonna have to give you part 2 in the morning. We're gonna talk about everything, and I'm sure we're even gonna get more news on it. But yeah, take this moment to like the video. Okay, amen. All right, I'm still waking up. You gotta wait a little bit, get some food. I'm not eating all of this. I'm not. Don't judge me. But yeah, good morning. All right, so I'm sorry for hyping you up. It really wasn't that crazy over there. Everybody was just sitting around. It was a lot of reporters. There was nothing going on. Like I was telling you, the headlines in the morning were like, there's all these black cars lined up outside. People were showing videos of like people lining up, but I guess that was like at the other branch. But at the headquarters, it was pretty dead. I did end up getting escorted out. Some lady was asking us questions. She was like, are you a banker? Do you work here? Are you a client? Are you a banker? Do you work here? I was like, I'm just a follower of the Lord. They didn't like that, so we had to leave. But nah, in all seriousness, though, nothing really went down there. It was kind of surprising. Even wake up in the morning, even from like last night till this morning. And I'm sure you guys probably read all the headlines, but there's like 15, 20 different companies that had their reserves at the bank. Even Roblox had a portion of their cash. Like I said earlier, Roku, they had a ton of money locked up in there. And even like USDC, I think like 6 to 10% of their reserves. This is one of those stable coins. They are even affected by it. But all that being said, this has just been a long intro. That's it. I hope you liked it. I hope you enjoyed it. We were talking a little bit on this on the stream, but I want to tell you my real theory now and the part two of all of this and what really went down, and like more so, this is just my tin. This is my theory. There's definitely there's many ways to counter it, but I do think it's a possibility. So here, let me just tell you what it is. The bonds will crash the banks. And what I mean by that is that the attractiveness of the bond market right now is going to be a threat to every single bank out there. And what happened here with SVB, this is a prime example. Now, obviously, there was other external things going on of why clients left, but let's start with the first topic. It's simple. The issue with SVB, it wasn't only that they had these unrealized bond losses. That was another update this morning. Apparently, the CEO of SVB was the CFO of Lehman Brothers. He handled fixed income there, but a lot of people are saying like, okay, the problem was the writing was on the wall because SVB bought all of those bonds a couple of years ago. That's it. They were done. And then the Fed raised rate and all of that, the unrealized bond losses there. Everyone's saying that was the big issue, but it wasn't the only issue. A lot of other banks have that. That's why we saw this freak out. I don't know if you're aware, even from Friday now, with how all of this stuff played out. This was the worst week for bank stocks since 2008, September 2008. That's WAMU, that's Lehman, that's all of that, right? So a lot of people were freaking out with the banks, and they're saying, well, all these other banks have these unrealized bond losses, but their deposits are chill. So what happened with SVB, the real issue was that they lost their deposits, whether it was because somebody in tech was struggling, whether it was FTX related, something with crypto. The point is, all of these Silicon Valley people who had their money in that bank, again, like you're finding out, it's companies like Roku, Roblox, even biotechs, all of these different people, but they pulled out their money little by little. And then on Thursday and Friday, after even like Peter Thiel and a lot of people, everyone said, we're getting our money out after that headline. So I was even talking to some people out here. They told me the same thing. Right after that press release, they pulled all their money out of it. People are like Peter Thiel was saying, okay, time to get out, and that led to, I think about within 2 days, $42 billion of requests to pull out money. So that's pretty wild. That alone is what I would say is the big problem with all of it. But what I'm trying to tell you is that this is the real issue, and the bond market plays a very important role. So this is the problem that I have, is that right now the bond market is so attractive that would be the only thing that could pull money out of the banks right now. What I mean by that is simply that if you have money deposited in a bank right now in your bank account, and let's say even the fear of banks gets even more, whatever it may be, or you're looking at the rates right now and you're like, wait a minute, I could get 4.5% risk free on my money. You see the volatility, you're watching banks literally fail. So what would people start doing? They would take their money out of their bank account and send it to Treasury Direct to go buy a bond. And that right there could lead to deposits for banks going down. Pretty much the more attractive the bond market gets, the higher the likelihood that people will want to pull money out of stocks, but also any money just sitting in a bank account. Why would you keep it in a Wells Fargo, especially if you have bigger money now? Why would you want to keep all of that money in there? And you're like, well, what happens if another bank gets clapped, whatever the reason may be. But point is, there's a very easy, rational moment to go and start buying bonds. So the funny part about it right now is that this is only going to last for a little bit until the debt ceiling, because now it's like, wait a minute, what if people are afraid of banks? And I don't think you should be afraid of banks right now. I'm not pulling my money out in places. I'm saying this is my tin foil with all of it, is that if a lot of people started pulling money out, like this was like, how GameStop, where a lot of people started buying it. If somehow millions and millions of people all got this idea, okay, I don't trust the banks, I want my money out, or just rationally from an investment standpoint saying, I'm just going to go put this at Treasury. The safest bank account right now is the Treasury up until the debt ceiling. But that's what I'm saying, is that the debt ceiling does make it a little bit more risky out of any other year to actually be looking at this. So what I'm trying to say here with all of it is that if rates keep going higher, if there's more risk factors in the market, in banking, and this does have some contagion in spreads, whatever it is, this could start to threaten deposits for every bank. But it's not only just like fear, just like naturally, the higher and higher the bond market goes, a lot of these banks are going to start having to deal with money going out for people chasing those yields and going after the safety that it provides. So that is my theory. I think it's actually quite interesting. And I actually forgot with this whole theory, the Fed stress test that already occurred in February 2023, but in their whole bank stress test, nobody has really, or even the Fed, they've never really put any stress towards customer deposits, pretty much a bank run. This doesn't happen. That's why even SVB, you haven't seen a real semblance of a bank run in a very, very long time, maybe since the early 1920s or 1940s. So it's not really something people have tested for, but with this whole theory, pretty much customer deposits leaving is the biggest risk to bank because there's high rates and unrealized bonds and a lot of other things. But now you have a treasury and a real incentive for customer deposits to leave. And yeah, this is a weird stress that has not really been priced in, factored in, and may not even happen. Or ever happen. But Chad, that is it. We got PAL, everything else. I hope you have a wonderful weekend. I'm already going to be out of here, so I'm going to be ready for the watch list, and we're going to be ready to go, baby. It's going to be a while. That's PAL 2 weeks, CPI, though. So God bless you. Chad, Horn. I don't have anything. I got a pencil. All right, I'm awkward at this. All right, good night, good morning, good afternoon, good evening, good night. Oh, wow. Okay, if you know, you know.